I invest alongside most multi-billionaires, and women, men, and some of them are content, some of them are miserable, they're not happy people. And what I found was that when the people who are more balanced, it's got to be more than just to make money.
Leading and scaling a business isn't hard because you lack ideas. It's hard because your time, your team's time, and your focus get eaten alive by the daily grind. Too many leaders are overwhelmed, under pressure, and bogged down by low-leverage tasks. I've learned this the hard way, scaling Nobody Studios, advising fast-growing startups and Fortune 500s, all while leading multiple ventures at once. I've seen firsthand how even the best executives get buried in meetings, lose strategic visibility, and burn out just trying to keep up. That's why I built the AI Executive Coaching Program, the same frameworks and tools that I've used in my own work to make it more meaningful, better leveraged, and more impactful. We're helping leaders in global businesses get hours back every week, turning chaos into clarity and operating with more leverage than ever before. This isn't theory. This is about identifying the traits you need to unlearn, the tasks pivotal to your success, and the tools that can be built into workflows to optimize your capabilities every day. From transforming meeting scripts into transcripts, into action plans, and spotting performance patterns you can't see on your own, we're upgrading the way executives lead. If you want to scale without losing your edge, let's talk. You'd be surprised how quickly you can lead at a whole new level.
Enjoying the podcast? Don't forget to subscribe and follow us on YouTube. This way, you won't miss any episode, and it greatly supports our podcast. Welcome to the Unlearn podcast. Today's guest doesn't just manage wealth, he reshapes what it means to steward it. Ron Diamond is the founder and chairman of Diamond Wealth, where he represents over 100 family offices with a combined net worth in the billions. But what sets Ron apart isn't just capital, it's conviction. After starting his career at Drexel Burnham Lambert and experiencing firsthand how institutions can crumble overnight, Ron made a decision that he would shape the rest of his journey, trusting people, not the companies. On this episode, we delve deep into why family offices are quietly reshaping capitalism, how Ron helps ultra-wealthy families invest in a profit with purpose mindset, the difference between short-term performance and generational impact, why philanthropy needs to be entrepreneurial, and how Ron sees legacy, integrity, and innovation as the new bottom line. If you're a founder, investor, or leader trying to understand how long-term capital really works, or if you're simply curious what it looks like to sit in the rooms where billion-dollar decisions are made, this episode is for you. Ron's not here to pitch you a fund, he's here to shape a philosophy and challenge to rethink what wealth actually is for. So let's get into it.
I had graduated from Northwestern University in 1987, and I got a job at Drexel Burnham. And Drexel, at the time, was the most profitable firm on Wall Street. It was like Goldman Sachs on steroids. And I got the job, and I was there for 2.5 years. And this was with Michael Milken and Junk Bonds, and this was the heyday in the late 80s. And 2.5 years later, I was in a room when Fred Joseph, the CEO of Drexel, said we're going bankrupt. And I'm in the room now. I was kind of new, so I didn't have a lot of stock options. But I'm watching people in their 60s and 70s, like mostly men, openly cry. And like it was a surreal scene. I remember it vividly. I could remember scents. I could remember facial expressions. I could remember like the woman with a big green thing on her chest hair. It was pivotal. And my takeaway from that was that I would always be loyal to people, like ridiculously loyal to people, but I would never, ever, ever be loyal to a company. Because if this could happen to Drexel, this could happen to anybody. And fast forward, look what happened to Lehman Brothers and Salomon Brothers and DLJ and Kidder Peabody and First Boston and Bear Stearns, and you can go on and on and on. So that was probably the moment that I was 24 that really changed my perspective on that business is about people and relationships, and don't focus so much on the company, but focus on the people.
And so that's a really sort of great insight straight off the bat, right? Many people, when they're idealizing their perfect job, their proper opportunities, I imagine you going into Wall Street, is they tend to focus on companies. They tend to think about, well, who are the big players in the market that I might want to play in? Say artificial intelligence now. Everybody wants to work for OpenAI or they've been poached by Meta. But that's sort of like the archetype of where these great companies want to be. But this is something I've learned myself too, that you've just sort of alluded to, is that it's actually the people that make up a company. And really being exposed to great people has been the huge accelerator for growth for me, for building relationships, for trust. And I actually tend to follow people as they move to different missions in a company, out of a company, wherever they might go. So, how did you start taking steps then after that moment where you realized, wow, I'm in what was one of the greatest companies of our time, and now I realize it's sort of disintegrating around me, and seeing the effect it has on these people? I often think you learn a lot about people's character when things don't go right. So who sort of stood out, and who were the people then that you were like, they're the folks I want to be loyal to or will continue to build relationships with as you build businesses in the future?
Well, it's a great question. The community, the Drexel Burnham community, we're still a very tight community. Um, when Drexel imploded and went bankrupt, the company was done. But I remember the people really rallying around each other, and there was a lot of camaraderie and helping people out together and doing things together. Leon Black came out of Drexel Burnham. A lot of very talented people came out of Drexel. And I just realized that the relationships people make with the people, that really transcended the fact that a great company it no longer existed. And it really made me understand the importance of people, the importance of relationships, and the fact that a company is just, it's a corporation, and a company could just come and go. But people, the relationships, that's really what transcends everything, and that's really, to me, the key to everything in business and I would say life.
Yeah, no, they're great lessons, right? And so when you're starting to formulate or build the relationships with people, it's great to even say that you're still connected with these folks today. One of sort of your philosophies, as I was reading around your work, is this idea of a guiding North Star, or profit with purpose as well, right? All these things of aligning yourself with great people, but aligning yourself with profit with purpose. Investments sort of anchored in the principle that goes beyond returns, but actually much more around legacy and social impact. So talk to me a little bit about how you formulated family offices to place capital into these impact-driven ventures. And is it the people that you look for leading these ventures that help you understand where you want to direct that investment? Or tell us how you sort of land on that.
Well, let's take a step back for a minute and talk. Family offices, what I do is I have a syndicate of probably about 123 family offices. These are families anywhere between 250 million to 30 billion, and we just invest together in private markets, private equity, venture capital, real estate, special situations, sports teams. I call it first call alpha. We don't charge anything, but I'm not doing it for self-list purposes. I do it selfishly because I don't have enough capital to put in $100 million per deal. Now I do, because we could aggregate. So I call it first call alpha. Making money is not really that hard if you stay focused and you're good at something. But making money with a purpose requires a lot more thought, and it requires a lot more really thinking about how you want to live your life. And what I found was that I invest alongside most multi-billionaires, and women, men, and some of them are content, some of them are miserable, They're not happy people. And what I found was that when the people who are more balanced, it's got to be more than just to make money. Because what happens is you buy a nice house and the house is great, and then you buy another house and that house is great for a little while, and then after a while you can only live in one house. And I think we live in a society that, we look at all these people who have 4 or 5 homes and all these different things. I mean, at the end of the day, to me, it's all about purpose, and it's all about how you can create wealth, but what can it do for you? So my North Star is, when I was working at Drexel Burnham, my father, who was my hero and I was very close with, brilliant guy, he was a banker at First Chicago, he developed prostate cancer. And what he did was he went to 3, 4 doctors and, top surgeons, and did everything he could, and he passed away 4 years later. My first boss was Michael Milken. And Michael Milken, around the same time as my dad, also developed prostate cancer. And he also did what my dad did and went to 3 or 4 doctors, but he did something else. He was he was a visionary. He created junk bonds, and he was just one of the top financiers in the last century, I mean, perhaps ever. And he wanted to solve it. So in addition to going to doctors, he kind of built it like a venture capital firm. So he put $5 million into this idea, $2 million here, $500,000 here, $3 million here, up to about $150 million. But he built it almost like a venture capital firm in order to save his life. And as a result of that, most men will die with, but not of, prostate cancer, because what he created. Fast forward 30 years, irrespective of what you think of Bill Gates, I would argue he did more for the cure of COVID than the U.S. government. He did this through his family office. Eric Lefkowski, who's somebody that I know in Chicago, who's the founder of Groupon, his wife developed breast cancer, and he didn't like the data. So what he did is he started learning and educating himself about this, and as a result, a company called Tempus was started, which is now a publicly traded multi-billion-dollar company. He didn't start Tempest to make money. He started Tempest to help his wife. And I think my North Star is that I don't think you can run a philanthropy or a charity exactly like a business, but I think you could run it more like a business. And it's my belief that a lot of these family offices who are run by entrepreneurs, they could take the skill sets that they had to grow their business, and everybody's been touched by something. It could be cancer, it could be diabetes, it could be autism, it could be anything. And my North Star is working with these uber successful, uber wealthy individuals who are entrepreneurial, who are taking their passion and doing it for a cause much far greater than just making money. And Sergey Brin has a predisposition for pancreatic cancer. He's donated $1 billion. Is he going to solve it? I don't know, but I put my money on him over the American Cancer Society. So that's my North Star.
Yeah, no, it's a great philosophy. I love the way you sort of described this through your structural alpha and social benefit approach, right? Defining the core principle of the mission early, that's well beyond financial goals. I think this is a really important part of creating any real focus for people, right? The examples you're sharing about specifically people who suffered from health moments and wanted to try and contribute towards that. And then aligning your efforts towards that North Star. Or the other bit I really like that you talk about is creating generational wealth that preserves value as well as assets. And this is really interesting for me, like the values piece about what these folks are trying to put into the world. They're really getting behind something that they almost have a visceral belief in, or it has impacted them, or it's really trying to make this positive, if you will, dent in the universe in an area that is important to them. So how do you start to find that out about these people, right? Like you're meeting all these phenomenal people. They're probably meeting someone every day who's looking for something from them, right? Something that they believe you should get behind my, if you will, like North Star. How do you surface what is truly their North Stars? So then when you start to put these deals together, it becomes values aligned, much more than just sort of capital and returns aligned. How do you start to surface that?
Well, one, I listen more than I talk. And, people in general are not great at listening. And what happens is we're having a conversation and then somebody says something and you're thinking about what you're going to say before they finish the sentence. And at the end of their sentence might be what's really important. So really listening, and I'm good at it. I'm not great at it. I'm getting better at it. But that's a skill set that I really try to work on. And I think it's a skill set most people, certainly in the U.S., aren't great at, can be better at. The other thing is I don't have an agenda. I'm at a point in life where, I'm not looking for anything. All I'm looking to do is add value to people. And what I found, and this is different than when I was younger, because I was much more transactional when I was younger.
Right, yeah.
But you get to a point in life where you just realize that the more you give, the more you get. It makes no sense. It's not logical. And I don't keep score. I don't do quid pro quo. But when I talk to somebody, even a $30 billion family office, how can I help them? Now, I'm not going to be able to help them make a great investment in something they don't know maybe, but one of the things I'll do is I'll introduce them to other family offices because, they're kind of siloed. So there's ways that you could add value to anybody. And by doing that, without looking for anything in return, it comes back in spades. I can't explain it why, but it's just something as I've gotten older that it's more of a belief, and it was serendipitous how it happened. But the more I give, the more I get. And I look at things through the lens of how can I add value rather than when I was younger, how can I get this person to invest with me, or how can I get this? It's much more relationship and much less transactional.
Yeah, I'm really enjoying you sharing this, especially over the last number of shows. We've actually done a real dive into giving, if that makes sense. We had Brad Field on the show recently. Brad's famous for really building a lot of the early playbooks for venture capital in the 1980s. He co-founded Techstars, one of the greatest accelerators, launched over 4,000 companies. And he recently just released a book called Give First. And one of the things me and Brad spent a huge portion of the show talking about is there was two principles that really stood out to me. This notion of giving without expectation of return, which again, certainly in my younger days, I was transactional. I was like, what's the deal that we're brokering here? What's the win-win? But what he was able to put a great language around that I've certainly experienced, and listening to you, certainly you've experienced, he talked about this idea of positive sum collaborations. And really what that means is that even you and I doing this show, we just want to create something positive from it. Something that's, you might get more from this, I might get more from this, who knows? But we're creating something together that has a positive impact for both of us. And that grows something. It compounds something. And for me, those two philosophies have just been something I've personally experienced in all the best companies I've built, all the best relationships with people I've had, any collaboration, is that it's always been a positive sum experience. And yet I go into them not expecting anything in return. Just being open to ways I could help people, maybe introduce them to someone that might help them on their North Star mission, or even just sharing what my North Star mission is, and that might be something that they help me with, who knows, in a week, a month, a year, 5. I've had people call me up 5 years later and say, hey, you're working on those AI companies again. I found this person who's delighted to get involved in helping build them. So it's sort of a fascinating thing that, again, I've only learned through experience and time, where so many people start from this transactional win-win, the 1 + 1 = 11, which isn't necessarily always true. It still leads to this notion that there's an expectation that something has to be returned, or as you say, a scoreboard. And yet all the best relationships I've had, there is no scoreboard. It's just people doing good things by one another to help grow whatever it is for everyone, and help others along their way.
A lot of it has to do, to me, with having a growth mindset. I mean, most people look at this like, here's the pie, and I'm going to do everything I can to keep this part of the pie, right? Rather than realizing that the pie can expand. And that's really the way I think you have to look at things. I think it's a much healthier way to look at things. In any business, no matter what you do, you're going to have competitors. Your competitors are not your enemies. Now, many people look at them as their enemies, but they're just trying to do the same thing you're trying to do, and you're competing with them. If you could look at your competitors as friendly competition and change the way in which you look at it, because so many people look at, I'm a real estate broker, or I'm an attorney, or I'm investment banker, or I'm a private equity guy, and the other people who are in my space are those are people I'm competing with, and the pie is only so big. It's not a healthy way, at least in my opinion, to live your life. And if I hope good things happen to everybody, right? When I was younger, I didn't necessarily want bad things to happen to other people, but I felt really competitive against other people in my business, in my niche. And if they would do better than me, or raise more money, or have a better return, I used to run a hedge fund, I didn't feel great for them. If you could change that, and I want people to be successful, because it doesn't matter. I mean, I've got plenty, I've got enough, and I want people to do really well, but it's just reshaping and repositioning how you look at things and how you look at people in the landscape that you play in. And it's very hard to do, because if you're a widget manufacturer and you've got two other major competitors who are widget manufacturers, oftentimes that is a very competitive, non-healthy relationship. But that's just negative energy. And if you could hope that they do well as well and have a growth mindset, maybe all three firms can do really well. It takes a while to come to that, but I truly believe that that's true, and it's a much healthier way to live your life.
Yeah, no, I couldn't agree more. These notions around a growth mindset, like Carol Dweck, great book, versus a fixed mindset of, people sort of fighting for resources. I'm a huge believer as well in an abundance mindset too, as well, as you're describing, that there's so many opportunities out there for folks. And actually, again, even to this idea, I even remember when I first started doing advisory work, there was a suite of other people who had sort of written books, or that, you were fighting for these clients. And again, when I started to realize that there was enough opportunity out there for everybody, and really what I should be is inspired by the people around me that are doing similar things, and recognize what they're doing well, and maybe I could incorporate into my own way of working, or also recognizing some of my strengths compared to other folks that made me different and unique. And what I always found, and it goes a little bit back to this values alignment, the best collaborations I always found was not when I was fighting just to win more clients or win more work or build more businesses. It was actually finding people who really believed in the mission that I was on, that shared the same values about how to build these companies. And that was easy work to do, because we were all sort of pulling naturally in the same direction, or gravitational force, rather than just trying to have this scarcity of fighting everybody and grabbing what I could, because invariably I'd end up with the wrong type of people to be working with, just because I was greedy to try and grab more or get more of this sort of limited pie. And again, so many times I remember I've sat down and said to myself, this person isn't the right person for me to work with. And I've walked away from bigger deals than deals I've taken, because they were the wrong people for me to be with, because we weren't values aligned, because that just sucks energy and lifeblood. out of everything that you're doing. But again, it's the hardest thing in the world sometimes when you're looking at two opportunities, and one might be worth $1 million and one might be worth 100K, but the 100K one is going to be so good for you because it's a great collaboration and could grow into a 10 million opportunity versus try to do something for $1 million with somebody who you feel isn't the right fit. And it just takes way more than that out of you, than not just the financial impact, but the energy impact, the broken relationships, the pain that you have to go through. And again, I think that's a hard thing for many people to face, especially earlier in their career. You almost have to make that mistake in some respects, I feel, to help you understand why sticking to your values, people that are aligned, who have great relationships with you that make work easy is much more important. All right, I'd love to ask you then questions around professionalizing family offices, right? We have this sort of massive explosion, if you will, in wealth at the moment, where we seem to be creating more family offices at a rate that I've never seen in my life. I feel like family offices launch faster than venture capital firms these days, but many of them really lack the infrastructure to really understand even the investments that we're working with. One of the things that we come up against in Nobody Studios, our venture studio, all the time is that businesses love what we're doing, or family offices love what they're doing, but they sort of hit a threshold, right? They're not a professionalized business. They're someone who's come into wealth that want to invest back into alternative assets, but they don't have the capacity to do more than a few deals. Once they do a few deals, it's chewing up all of their ability to support those deals and then due diligence and then grow, and they get trapped and they get sort of stuck. And so I'd love to hear some of your ideas about, how do you think about operationalizing some of this new breed of family office? How do you help them understand how to do governance, recruit talent, understand when to grow, how to grow? Because I think this is probably one of the main limiting factors, if you will, for even great capital to be flowing into early stage ventures at the moment. Right. Because I think VCs are a little bit too far removed from entrepreneurs now.
Well, let's take a look. Let's take a step back and kind of look at where we are. There's currently $10 trillion in family offices. Now, to put that in perspective, there's 6.5 trillion globally in the entire hedge fund universe. So this market today is larger than the entire hedge fund universe. But we are about to experience the largest transfer of wealth in history. Over the next 20 years, there's $124 trillion that's moving downstream from the baby boomers to the next gen. It will be the largest transfer in wealth in history by far. And so these family offices are going to get bigger and bigger and bigger. Having said that, because you're good at making widgets doesn't mean you're good at investing. And I think the biggest obstacle to many of these family offices is the ego of the founder, the matriarch.
Yeah, right on.
And because you were really good at something, I'm really good at a couple things and I'm really bad at a lot of things. But because you're good at something where you made a lot of money doesn't mean you're good at everything. And I would argue 85-90% of these family offices that exist right now probably shouldn't exist objectively. If you're looking at just from a bottom line standpoint, there's no playbook. So what I'm trying to do is I believe that when I graduated from Northwestern in 1987, they used to call them leverage buyouts, and that was a precursor to private equity. And private equity and venture capital became a multi-trillion-dollar industry. And it really was a better model because when I'm running my hedge fund, if you have to report to me or somebody on Wall Street every 90 days, it's a hard way to run your business because you're basically kind of managing your earnings. So the private equity model was 2% covers the overhead, 20% I make money if you make money. And that was a better model. So that exploded and became a very lucrative multi-trillion-dollar industry in private equity and venture capital and real estate, et cetera. What happened, which happens a lot, is that not all, but many of the firms, they almost bastardized the business. It became an AUM game. And they started to realize that if they could grow to $5 billion and they're making 2% on $5 billion every single year as an annuity, it changes the mindset. So I'll give you a
We're tired
specific.
on that alone, right? Like this is the billion dollar funds and not living on
Well,
2%
I'll
fees.
give you a
Like it's a
specific
dream.
example. So I had a very good friend who did a roll up of logistics companies, and he had a phenomenal track record, and he needed $150 million. And the placement agent who worked with him was able to raise a lot of money for him, and he was able to raise almost $500 million. So he calls my friend and said, "I've got great news. Not only was I able to raise you 150, I am actually able to raise you 500 based on his track record." And my friend said, "Okay, great. Yeah, I just need 150 and let's get started." And the placement agent like was dumbfounded and kind of like walked over to his house. He's like, "What am I missing?" And my friend said, "What are you talking about?" He said, 2%, and he writes it down paper. 2% of 500 million equals X. 2% of 150 million equals Y. What am I missing? And then my friend realizes what he's talking about, and he was a bit incredulous. He said, "Well, here's what you're missing. If I do what you want me to do, there won't be a fund two, because it's a niche strategy, and I can't deploy the other $350 million, right? I'm smart enough to know that if I take 500 million and I get 2% of that, I will make more money today than I will if I took 150 million, but my investors wouldn't do as well because I can't deploy that capital. So it's a myopic way of looking at things, and I think that's a microcosm of, again, I'm generalizing, but
Absolutely.
what's
Yeah.
wrong in the industry, and it's become an AUM game, and it's got to change. And I think that to create alpha in the private equity firms, it's not investing in the KKR or the Apollo that have raised $20 billion funds. It's usually the 100 million to $1 billion funds. It's the smaller ones. Small is relative, but it's a smaller fund where you could truly create alpha, and you have to be aligned where with a growth mindset that your mentality is, I'm going to make so much money for my investors that because of that, good things will happen to me, rather than looking at it, I'm going to raise as much money as possible, and 2% of a bigger number is more money for me. So what it forces people to do is invest in companies. Now you've got more money than you need, and you're investing in companies and overpaying for them. So
Yeah.
I have a syndicate of family offices, and we'd look at deals, and we'd maybe think a company's worth 150 million dollars, and we were ready to buy it, and then a private equity firm would pay 2x that, and there's no way it's worth that. But what are their options? The options for the private equity firm are they either invest and overpay, or don't invest or give the money back. I will promise you they will never return the money. And so what it does is it forces people with all of this capital to deploy it and oftentimes overpay for it. Then the results go down. That's why the smaller funds typically, from an alpha creative standpoint, you can create better alpha with a smaller fund. So I think that it's almost backwards the way people look at things as a GPs. And if you look at things as a GP as if you were an LP, look at it through their lens, and it's not hard to do that. Short term, you're not going to make as much money, but medium and long term, you'll do exponentially better.
Right on. This sort of philosophy rings massively true in my world too as well, right? Like my world of building early stage companies, we're a venture studio, right? So we're basically a VC incubator accelerator rolled into one. And one of the things that I have certainly learned, especially about how we build companies, is it's almost better to be really constrained about how you make investments, like almost come from a scarcity mindset in terms of like getting things to prove their value before you put significant capital into them. Like our whole philosophy is when we have a new business idea, we don't deploy $1 million into it. We put 5 grand into it. And can we show some sort of proof or traction that it's starting to make progress? If it does, then we give them 25. If they make progress and show more success, we give them 50. And we start to scale up the investment as the companies start to show promise, rather than every scenario where we give the startups a big lump of money and say come back over a large period of time. Invariably, they overspend, they're too slow, bad behaviors start to set in. So it's very interesting again when you see that propagate all the way up to, as you're describing, in large markets with larger amounts of capital and investment. When people have abundance, if you will, in the capital sense, then they start to have bad behavior about how they start to manage and apply that. So tell us a little bit more now. You've talked a little bit about this massive sort of transfer of wealth that's about to happen. A lot of the people, again, I see in family offices are typically, maybe there's a entrepreneur who's built a business, being massively successful, and then they want their children or their next of kin to be involved in the business, but they're not interested in building a hardware manufacturer. They want to be involved in a tech company, and then invariably they end up running these family offices and sort of going out to try and invest in tech with very little understanding of it, just that they know they want to work on tech. What are some of the values that you think are really important that need to be started to pushed into these people when they start to actively invest? Like, what are the things you're teaching these family offices in your syndicate to help them have a better perspective, to have a better set of values and identify investments that are going to work well for their strengths, if you will?
Well, right now, first of all, the model doesn't work. Only 25% of family offices that exist make it to the second generation, and 10% make it to the third, and 5% make it to the fourth. So everybody's trying to become a family office, and it's kind of like a buzzword right now. But there really is no playbook. Like, how much money do you need to have a family office? Let's say you sell your widget company for $50 million. That's a lot of money. It's not even close to enough money to have a single family office. In order for it to make economic sense to have a single family office, if you're going to invest in the private markets and have a deal team, you need a bare bones minimum of $500 million. Some people would say $1 billion. Now, there are a lot of people who have a lot less money than that have family offices.
Correct.
But if you reverse engineer it, they'd be better off with a multifamily office, because multifamily offices were created for families between 10 million and 250 million, right around that area. So rather than paying for your own accountant, your own lawyer, your own admin, your own staff, you're splitting that with 10, 20 different families. So it's cheaper. Now, it's not strictly yours, but it's much more inexpensive. We don't have a playbook right now in the family office to say, okay, I had my liquidity event and I sold my company for $1 billion. What do you do? Well, what most people do is it's in the paper, right? And your friends realize, and the people at your country clubs or in neighborhoods realize you've made a lot of money because it's written, and you start investing. And that's like the last thing you should do. So what I'm trying to do, and I put together a family office initiative at Stanford University, and I'm just built one along with a couple other people at University of Chicago Booth, is we're trying to create a playbook. So you have a liquidity event. What do you do next? Well, what you should do next is something called governance. Most people who have a liquidity event don't even know what governance is or why it's important. Then you need something called a mission statement. Then you need to talk to an estate planning attorney, which is the boring stuff, but that's like the foundation of a house. Then you need to talk about succession and next gen. After you've got they call it soft skills, I call it power skills. But after you've got all those power skills worked out, which could take a year, 2 years, at that point you're ready to invest. But it's backwards. And there is no playbook. So what I'm trying to do, we're creating a program at University of Chicago Booth where there is a playbook, where have a liquidity event. First thing to do is start with governance, then have a mission statement, talk to an estate planning attorney, do A, B, C, D, E, then start investing. And there is nothing like that right now. And I think that's going to change. But I think we're at an inflection point. I think that as private equity and venture capital disrupted the public markets in the mid to late 80s and going forward, I don't think family offices they'll never replace private equity or venture capital because you need them as a throughput. But I do think that family offices are starting to and will continue to disrupt private equity and venture capital because they've got something called patient capital. So the way the model works today is a private equity firm buys a garage door company in Des Moines, Iowa. And when they buy that company, I could pretty much tell you about when they're going to sell it. Not because I'm so smart, but because I know how they're compensated. And they're going to probably sell it in 4 to 5 years. So what happens is you have a garage door company in Des Moines, Iowa that's purchased by a private equity firm. They're going to hold it for 5 years, and then they're going to sell it. Sometimes they sell it to a strategic, but oftentimes they sell it to another private equity firm. They're going to hold it, and I can tell you approximately when they're going to sell it because I know how they're compensated. They're going to sell it in another 5 years. So if you look at over a 20-year period, let's say it changes hands 4 times. If you look at the taxes and the friction and the disruption in business versus a family office who could simply buy it, hold the company, let it compound, the results aren't even close. Here's the problem. Very few family offices can execute. So we've done work with the Pritzkers or the Dells or Crowns, some big families. They can execute, but they're the exception. What has to happen is you have to have an industry that can, if you want to compete directly with KKR or Apollo or Carlyle Group, you have to have the talent. In order to have the talent, you have to have the compensation structure. So right now, I'll give you just one small example of what's wrong with the family offices. Most family offices right now, if they pay a kid out of Stanford Business School $250,000, not all, but most of them look at that as a cost. In other words, that cost me $250,000. I can promise you that when Carlyle or Blackstone or KKR pays that kid $250,000, they don't look at that as a cost. They look at that as a potential $20 million profit center. So it's kind of nuanced. But until family offices start, and that's only one of things they have to get right.
Yeah, right on.
But there's a lot we have to get right, and how we pay them, how we incent them. We've got to give them lines of credit. We've got to give them part of the carry, because you're not going to attract the top talent if you're not going to pay them, and you have to incent them. So there's a long list of things that we need to do to get it. But right now, the family office model is broken. We are at an inflection point. And I think it's going to get solved, not 100%, but we're doing it at Booth, and more schools are reaching out. I think in 3 to 5 years, maybe 7 years, almost every major business school is going to have a family office initiative similar to what we've created at Booth, which will have a playbook because there's so much capital in it, and people will realize how to do it. Because Ty Warner made a lot of money in Beanie Babies, and he was a brilliant businessman, doesn't mean he has the capacity to buy the Four Seasons Hotel, and he got clobbered on that. Again, that's just a microcosm of huge amounts of capital. Ego probably played a little bit of a role in it. Because I created Beanie Babies, I could buy hotels. It's a different skill set. That's the problem. So the biggest competitor that many of these families have, truthfully, is the ego of the founder, the matriarch, patriarch. Not all, but many of them.
What a great point. And look, you're doing great work in this space. I'm really glad that you're putting your time into something like this in Booth. It's in Chicago and bringing these people together. As someone who's sort of on the opposite side of the table to most of these family offices a lot of the time, you see this, right? You see the excitement, you see the opportunity, you see that they generally have a curiosity to support entrepreneurs and help grow the pie for everybody. But there is a severe lacking of tools, as you're describing, about how to think about going to build a family office, like having a clear mission statement, governance, how they want to do diligence, how they want to bring other people into deals with them. Even the way that they do diligence on some of these businesses is very different depending on where they have come from or the types of companies that they've built. And again, what I experience, because I'm on the tech sector, is you find a lot of folks who've built amazing bricks and mortar businesses, maybe retail businesses. The second generation want to do tech. They want to get away from what made the family successful. And yet they just have an interest in the area rather than a skill in the area.
It's interesting. Jeff Bezos made a comment I think it was on a webinar I was listening to. And he said that the biggest advantage he has is time. And what he meant by that is, he goes, most of the world looks at things in a 3 to 5 year time frame, right? Which is how the compensation model works. if I could look at things from a 7 to 10 year time frame, I've got a huge advantage over them because I've got time, I've got patient capital. And I think that if you could look at things from that perspective, it objectively is a better model. The problem is most family offices can't execute. That's going to change. And when the family offices start hiring the talent and start getting the compensation model right and start understanding the playbook with the governance, succession, the next gen, and the importance of an estate planning attorney and after-tax returns, not just pre-tax returns, and all of this stuff, they are going to disrupt the private equity model because it is objectively a better model. Today, only very few firms can execute. So it's not, I wouldn't be overly concerned if I'm Carlyle or Blackstone or KKR. That's going to change. And over the next 20 years, as more and more money gets transferred from the baby boomers to the next gen, and as more and more schools like Booth or Kellogg or Harvard or Oxford or some of the top MIT coming in and start planning it, the competitors for the private equity firms are not going to be the other private equity firms. It's going to be the family offices. And we objectively have a better model, but we just have to figure out how to get there. And we're still a long ways away. I used to think we were in the third inning. Then the more I learn about I now almost think we're in the second inning. And the more entrenched I get in this, I almost think we're in the first. So I think that we are at an inflection point, but a lot of things are going to change. And, I think that family offices are going to fundamentally change two things. One, which is less important, they'll fundamentally change the way companies are financed going forward. It's a better model. Two, more importantly, again, it's not a panacea, but many of these family offices are going to solve a lot of these real world problems. Yeah. Because I don't think the philanthropy, you can't run a philanthropy exactly like a business, but if you've got an entrepreneur who's got the means to do it, who's got the cause and has been touched by their child that got cancer or their mother had dementia or whatever it is, the families they're going to solve this. It's not going to come from the government. They're not that good at it. It's not going to come from the corporate sector, in my opinion. I think a lot of these real world problems are going to get solved by family offices. Again, it's not a panacea, but if you think about it objectively, you have the capital, you have the entrepreneurial spirit, you have the inner cause because they've been impacted by something, let's call it diabetes, and they want to make it better. Michael Milken was a perfect example with prostate cancer. Bill Gates with COVID. My friend Eric Lefkowski with Tempest. I think that's going to change. So the two biggest things that family offices are going to do is fundamentally change how companies are financed, which most people are going to look at and say, that's huge, and it is. But the true biggest thing, which is my North Star, it's going to fundamentally change the way a lot of these real-world problems are solved, and we've got a lot of real-world problems.
Well, Ron, firstly, thank you for doing this work. Thank you for putting this course together at Booth, for raising these challenges, because I, as an entrepreneur, know it's going to help the ecosystem overall. The one thing I'm also here listening to you share is that we're all going to have a bit of patience to get there, and think that this isn't a quick turnaround, that this is a thing that will take maybe 7 to 10 years. Maybe we are in the first inning or the second. But it's just like when you think of investments over the long term, I think us investing in raising the bar and the understanding for how family offices can be better is going to be a huge component. Listen, thank you for joining us, sharing your knowledge and your wisdom. And again, I'd recommend anybody who's interested to learn more, make sure you follow Ron, check out the course that he's running in Chicago. And thank you very much for sharing with us.
And we've got a media company, familyofficeworldmedia.com, which is something that if people are interested, we try to just put content out there in education. So that's a good way I think they could follow me.
Fantastic. Thank you very much.
Thank you.
Thanks so much for listening. If you found this episode useful, make sure you subscribe on Apple Podcasts, Spotify, or your favorite podcast app. Please consider leaving a rating or a review, as it helps others find our podcast. For more episode and details about the show, visit barryoreilly.com, and we'll see you on the next episode.